Well, the selling we've seen in recent weeks really has all the earmarks of the big money institutional crowd at work. Basically they're unloading shares later on in the day, usually near into the close. And it's interesting that some of the stocks in the sectors hit hardest so far this year were exactly last year's best performers. Meanwhile, some of last year's laggards are now performing very well in April in spite of this volatility. For instance, the hardest hit sectors so far this month include biotechnology and especially internet stocks. Now, those two sectors finished number 1 and number 2 in performance last year. So it looks to me like this recent correction in the market is more about sector rotation within the stock market, rather than just broad-based indiscriminate selling of all stocks. In other words, the big institutional investors are just reallocating some of their cash, maybe taking some profits in last year's big winners and moving some of that money into more undervalued stocks and sectors. Money is finally starting to pile into some of the out-of-favor sectors from last year. Case in point is mining stocks. You can't really find a more beaten-up sector than the Philadelphia Gold and Silver sector index of gold and silver shares. They got killed in 2013, but mining stocks are up almost 10% year-to-date, even after a short recent pullback here. In fact, commodities in general have really rebounded in a big way. We've seen, the overall commodity indexes 10-11%. Some are doing even better than that. Also, emerging markets have really rebounded this year. Not uniformly, but select emerging markets have performed very, very well, especially emerging Asia. So this rotation out of last year's big winners and into some of the more beaten-up stocks we've noticed is kind of a consistent trading pattern. It seems like it's the institutional money reallocating. And, they're waiting until the very end of the day to make their move into and out of the stocks. So, in the short run, that's kind of a red flag for the market. It's a sign of, we see the selling just ahead of the close, and until the smart money starts buying again, stocks could stay under pressure for a while. Well, I guess the good news in all this, the silver lining, is that most stocks and sectors are already approaching oversold levels now. For example, the biotech stocks are already down 21% from their highs they reached at the end of February. So the biotech's in its own private bear market, even though the Dow and the S&P are only down about 2%. So a lot of these sectors are washed out, and we're looking for selective strength and buying opportunities here. In fact, once you start to see more buying on strength into the close rather than selling during the last half hour, that'll be the first sign that stocks are stabilizing, and this correction we've been in the last few weeks could be coming to an end. For Money and Markets, I'm Mike Bernick. Good investing.